So in the last 12 months, I made $42,000 selling options. And what I thought would be fun in this video is walk you through the trades, the underlyings that I've traded over the past 12 months, how much money they brought me, why I've traded them, and then lastly, we'll go through into the top trading strategies that I use to sell options to make over $42,000. And all I ask for is that you smash that like button and don't forget to subscribe. So what we got here is I've took a statement of all my trades over the last 12 months. And if I highlight over column G, which is the proceeds column of total premium collected in that time, you can see here it's $42,001. So really happy with the amount of premium I've been collecting throughout the last 12 months. And if we look at the number of trades, it's 366 because it's taking into account the header. So just over one trade a day. And you might be thinking that I'm looking at the charts and analyzing when to get in, when to get out. I'm telling you, this is not how I trade. I've been doing it on my phone, just looking at implied volatility, just looking at the options chain. I rarely look at charts, and if that is something you guys really hate doing, looking at charts, then I strongly suggest that you stay tuned until at the end of this video where I go into my top trading strategies. So again, this is just a lot of data here. So what I've done is I've taken this data and I've put it into a pivot table to show you which underlines that I've been trading. And you can see here, I've only traded 14 underlines in the last 12 months in terms of selling options and buying options. So this is the total. And this is why you've got, a negative figure here for SoFi, because I've bought a leap in SoFi for around $500, which is why you see a negative there. And then what we've got is the total premium for each one of these underlines. Now, I'm not going to talk through all of these. I'll just pick a few of them. And then what we'll do, we'll go into the strategies that I've used for these particular stocks. So you guys can get an idea of what I'm doing on a daily, weekly basis to generate $42,000 a year selling options. Now, the biggest one is Riot, which is over half of the total amount. And this is because I own quite a lot of shares of Riot all the way back at 2020, early 2021. And what I've been doing while Bitcoin has gone through its bear cycles, its bull cycles, etc., is I've been selling covered calls. So there'll be no doubt, spoiler alert, that the top strategy that I've been using to generate 42,000 is covered calls, because that's primarily down to the stocks that I own in Riot. And we'll go into what a covered call is shortly, but Riot is such a great stock. It's a volatile stock, follows Bitcoin. It's a Bitcoin miner, similar to Mara, similar to Hut. And because of the premium it generates, whether you're selling puts or selling calls, you can make a decent amount of return on the shares that you have. Now, my shares are down by quite a lot of money, but every time it keeps going up, I sell covered calls on my 15, 20 contracts or 2,000 shares that I own to generate that passive income every single month. The next one is IWM, so that is the Russell 2000 index, or the small cap index. And again, without going into the trading strategy that I'm using, is IWM has been a great stock because it's been range bound for between 2021 to 2022 and 2.5 or 6 months into 2022. It's been kind of range bound, and then it broke out to the upside, which caused me a few challenges. However, I'm still in a number of IWM trades, but I'm collecting premium every month and improving my strikes position, which we'll talk about before. One of my favorite stocks is Tesla. Tesla's just got high volatility, high premium. It's really good. The problem is with it is you have to pick the right strategy, because if it's going up, you want to be selling puts. If it's going down, you want to be selling calls. Strangles is what I've been using. Has caught me a few times, but I've managed to get out of it by utilizing the premium collected and then getting out at either a small profit or break even. But overall, made 6.4 grand on that. Nvidia as well It has been absolutely fantastic, similar to Tesla, very volatile. It's an expensive stock. I do have over a six-figure account, which has allowed me on margin to be able to produce trades with these two underlyings. Misty, again, is a yield max fund about my dividend portfolio or high income yield. I've never owned Misty. I've always just sold puts on Misty and generated 1100 without even owning 100 shares of Misty, which is good. Palantir's always been a decent one for me. It's around $88 stock now, but back in the day when it was in the 20s, 30s, and 40s, you could ride that bad boy up by selling puts on those, which is all good. Nike, I've done a couple of things. You guys know that I'm trying to get into Nike at around the $70 mark. And again, I've been selling puts and not being assigned and therefore generate some money. Spotify, it's a very expensive stock. It's a $200-ish kind of stock. It was a $500 stock. I think I can't remember from memory what it is. But this was a pure earnings trade. Within 2 days, make $258, which is all good. And then Connie, TSLY, YMAX, and ULTY are yield max funds, which I've utilized options trying to get into these stocks to buy and accumulate shares within those. So you can see by ULTY, I've made money, little bits of money. But again, this is just, what do you want to call it? I'm trying to work out the word that I'm trying to use here, but it's just effectively the kind of charges that I need to incorporate utilizing options to buy the stock, which again, they're so small, they're a rounding error in this overall kind of spreadsheet. PayPal again is I've been selling puts to build a position. PayPal has taken a bit of a tumble over the last month or so, which all stocks have. But again, I'm not selling any covered calls on those because, if it does take off, which it did do before it came all the way back down, I don't want to get caught in those stocks. And then SoFi again is a minus figure only because I'm selling leaps. I've got one leap on there, which again I'll do an update video on shortly. But it's pretty much at break even from when I purchased it from there. So again, this is a lot of money, and the time taken to generate this money, I don't want to say it's been easy or doesn't take a lot of time, because I spent a lot of hours understanding options, understand how they work, how to mitigate risk on these options, how to roll these positions, all these kind of good things. So I don't want to underestimate the effort required to be able to do this. But once you understood it and it clicks for you, then not only can you make a lot of money, you can make a very decent return on the time spent in terms of placing an options trade. So, and that's what I try to teach on this channel. So again, make sure you subscribe if you're interested in learning how to create income and how to do that with the least amount of effort. And then in this one here, what I've got are I was going to do 5, but if I was honest with myself, it's really only 4 really strategies that I utilize to generate income. The first and foremost, only because it's the biggest one, because I own a lot of stock. If I didn't own this stock, then I wouldn't be doing this strategy. And that is covered calls. And covered calls is, as the name suggests, you're covered by the stock, and you're selling out the money calls predominantly above your cost basis to generate income off while you're holding the shares. And a lot of people talk about covered calls as the stock itself is a house, and then you go and rent out the rooms in your house, which is selling a covered call, and you get rent through that option premium through tenants inside a house, and therefore generating rental income while you hold the stock. All honesty, challenges with covered calls is if you love the stock and then you selling out the money covered call and the stock goes all the way up, again, there are things you can do to get out of that position without taking a loss, which is too much effort in my view to be able to handle, not from an execution perspective, but more from a mental perspective, which is why you'll see here that PayPal only has $142 in income, whereas I don't want to sell covered calls on it, because if it does go past my cost basis and I then have to manage that position, because I don't want to get rid of my stock. So unless there is an opportunity where Palantir's volatility is completely off the charts and I can sell a really far out the money covered call on my, I think it's like 400 shares, 500 shares that I've got, and generate a couple of $100, then I'll do it. But then the risk is getting a couple of $100, then if it passes my strike, then I've got to do some management with it. So again, it's just one of those things that, just be smart with it. If you love the stock and want the stock and you know, if you sell a call and you don't want to sell it at that price, just don't put the covered call on. But for Riot, which I'm looking to get rid of the shares, not at the current price now. Obviously, it's tanked slightly post Bitcoin, but it's part of the main strategy. The next one is my 111 trading system, and again, I've been talking about this in the last couple of videos. In my last video, I did one on Palantir, so make sure you check that one out. That one's nicely in profit as well. I think it's 60% of the total credit I've received, which is all good. And this is effectively selling a debit spread or a debit put debit spread or a call debit spread, depending on which way you're doing, which is obviously, as the name suggests, you open the trade or as the trade goes on as a debit strategy, and then you sell another out the money call or put to finance that, to open it as a net credit trade. And again, I am creating a guide on this because this is the one. If I go back to this 42 grand, obviously 21k of it is there, but the other 20k, around 10-15k of the remaining, is done by my 111 system, and it's a very publicized trading strategy out there. They're called bull put ladders and various other variations of what it's called. But I feel the way I've kind of created it in my own kind of massage my own way into how I utilize the system, and also how I utilize, if the trade does go against me, on how I manage the trade. So again, I'm creating a guide on this, so please watch out in the coming weeks when that is available to get your hands on. The third one is your standard strangle, which is an out the money call and an out the money put at the same time. It is an undefined risk strategy where you're looking for the stock to stay in between your short put and your short call. And this is the one where I get the most questions about in terms of when I'm teaching options trading, is why would you put a strangle on? What if it goes up or down one side or another, as opposed to just selling the put or just selling the call? Now, that is true, right? If you sell an out the money strangle and it goes up past your call strike, or it goes down past your put strike, then you would have been like, I wish I never put on the other side. But the reason why you put a strangle on, first and foremost, is you don't know what's going to happen, right? So if you sell the 16 delta on both sides, again, the probability of it touching that or expiring in the money at the date of expiration is still quite low. So the odds are in your favor that it might go up, it might go down, but it may not end up touching any one of your sides. So that's the first thing. The second thing is you generate a better return on capital, because when you just sell a naked put, which is obviously the fourth one, which is a bullish strategy, you want the stock to go up, it's going to cost you a certain amount of buying power or margin to place that trade. Now, if you then sold the call on top of it, and out the money call, you generate more premium because you're putting on another call side, but your margin and buying power pretty much stays the same. So what that means is you're making more premium for the same amount of risk or margin that you're putting up. And that, to me, makes more logical sense in terms of how to generate, or how to be more efficient with your capital and generate the most income or premium for the margin or buying power you need to put up. And yes, again, you are then putting risk on the other side of the trade. However, there are mitigation strategies and rolling tactics, etc., to help you get out of this trade. And I might put a course together on that. It is a very complex system to be able to do it, which is why a lot of people come and get my coaching and understand, so I can work with them one-on-one and look at it in real time, what's going on, when to adjust positions, when to close. And the most important thing I can say when it comes to doing strangles is knowing how much premium you've collected over a number of trades that you've done within the same underlying. So for example, I'm in a strangle at the moment in IWM, and it's gone completely against me. IWM is absolutely rocketed, and then it has come all the way back down, and I've got a deep in the money put and an out the money call. Now, I've collected 9 grand in premium over the last 12 months. Now, if to close the trade out, let's say it costs me 5 grand to close the trade out, as an example. Therefore, I can actually close out the trade and still That clearly doesn't. It's not the right answer, is it? So it's what, 44138, right? So instead of making 9 grand on this trade, I can make 4 grand on this trade. So it's still profitable, but not as much as the 9 grand because I'm going to have to take a debit of 5 grand to close the position. Obviously, the goal is to close the position at break even, zero, or profit. But this is where you need to record how much premium you're actually collecting on a daily, weekly basis for a particular underlying that's gone against you. If, like my 111 on Palantir, for example, I'm up 65% on the, I think it's $160 or $180 that I've created. So I can close that position for $80 profit, all good. But something that's gone against me, like IWM, I'm noting down all the little credits that I've made, which is total to $9,138, and I will continue improving my cost basis. So in this example, lowering my put down every cycle that I get an opportunity by $1 or $2, whatever it may be, and potentially using some of this credit to bring that put down even further, which is why I love strangles and undefined risk strategies, because you have the ability to manipulate your strikes with the premium that you are collecting. So again, this is the part where people in options don't really talk about. It's very hard for me to record all this stuff in real time when I'm making these trades, but this is why, again, one-to-one coaching is so important, and why people give up on options and give up on selling puts and strangles when they go deep in the money, because they don't actually want to own IWM, for example. So again, this is the bit where you need to understand why you get into these trades and really think about what is your exit plan if something goes wrong. Because like I said, I've got an 80-90% win rate. 8-9 times out of 10, everything goes correct. But in that 5 to 10% chance where it doesn't go, like an IWM, then this is where you need to look at, okay, I've collected 9 grand. It cost me 5 grand to close. I could close it now. I'm choosing not to. I'll continue to roll, improve my cost basis on my put side. If it gets to a minus 3K, for example, then I will decide to close this down at a 7K profit, or whatever the answer is. So I've honed in on that point a little bit, because that is the quite important piece that you need to understand with any of these strategies, because they all can go against you, including the puts as well, and covered calls as well. The only advantage of covered calls, if you sold it above your cost basis and it does go higher, you are covered by the stock and you will exit with a profit. Where the other three, if you get a move one way or the other too extreme, it does causes you problems. Which is why I love the 111, because of the debit hedging strategy. So it lowers your break-even point and allows you more flexibility as you roll the trade, and easier to get out of losing trades. So you pick up less credit on a 111 than you do on a strangle, and then you do on the puts, because you're buying a debit spread as part of the strategy. But it gives you a lot more peace of mind is when it goes against you. You can not only make more money, but increases your break even. And I think only once in 4 years it's gone past my break even point where it's taken me another cycle to get out of the trade with some sort of profit or a break even. So that's why I love it so much, and that's why I continue to use it. So I think that will be all for this video. Again, like and subscribe. The 111 strategy guide is coming out soon. Just trying to put it all together and get some decent bonuses out for you guys, which has got in-depth training and a real live examples of me doing these trades, how to manage these trades, etc., etc. So all I ask for is that just bear with me on it. I know you guys have been asking. Make sure you like and subscribe, and I shall see you guys in the next video.